Final learning objective for this session is the cash flow identity. Very, very important. Especially in the small business, everything revolves around cash flow. The saying is cash flow is king in the small company. Having been in a startup, being one of the founders of Lycom Technologies, I understand that very, very well. Cash was very tight. We started the company with $6,000, could barely afford to pay the rent, the motif, the furniture was early cardboard box, and everyone took out the trash. We couldn't afford to hire a janitor or anyone to clean the place up. We cleaned it up ourselves, no matter what our title. Difference between the numbers of dollars that come in, cash flow in equals cash flows out. My electrical engineering prof used to say what goes into comes out of. So what goes into the company, cash flow from assets, goes out of the company in the form of cash flow to creditors and cash flow to stockholders. CFFA is the abbreviation I use for cash flow from assets. That's also known in some circles as free cash flow. Free cash flow. Cash flow identity does not equal the statement of cash flows, although you'll see some similarities and some components that are used similarly in both. CFFA equals CFTC plus CFTS. That looks a lot like the balance sheet equation. Assets equal liabilities plus owner's equity. CFA, so we have to know how to calculate the components. Cash flow from assets or free cash flow is equal to OCF minus NCS minus CNWC. Operating cash flow minus net capital spending minus change in net working capital. This is known as cash flow from assets or free cash flow. That's also equal to cash flow to creditors. It goes out to creditors and out to stockholders. As I said, similar to the balance sheet. So that equation you don't have to memorize because it looks very, very much like the balance sheet. How do I calculate cash flow from assets? OCF minus NCS minus CNWC. Where do I get CFTC? Cash flow to creditors, interest expense paid off the income statement minus net new borrowing from the balance sheet under long-term debt. Long-term debt ending minus long-term debt beginning gives you net new borrowing in the year. Cash flow to stockholders is equal to dividends paid, usually posted at the bottom of the income statement or in the footnotes to the annual report. You'll find dividends paid. Minus net new equity raised off the balance sheet. Ending equity minus beginning equity, that will give you your cash flow to stockholders. How do if I want to calculate CFFA the other way, OCF minus NCS minus CNWC, I have to know how to calculate operating cash flow. EBIT from the income statement, depreciation expense from the income statement, tax expense from the income statement, income statement, income statement, income statement. So if you see the letters OCF, you better run off and calculate and build an income statement because that's where all the parts come from. Net capital spending comes from the balance sheet and from the income statement. I take ending net fixed assets off the left side of the balance sheet minus beginning net fixed assets off the left side of the balance sheet minus depreciation expense. You can get that from the income statement or by taking the ending cumulative depreciation minus beginning cumulative depreciation off the balance sheet. So as I said, you can get depreciation expense. The easiest way is just pull it right off the income statement. That will give you net capital spending for the year. And finally, how do I calculate my change in net working capital to wrap up the CFFA calculation? Ending NWC minus beginning NWC, and we all know that net working capital now is current assets ending current assets minus current liabilities minus beginning current assets minus current liabilities. That will get you to your net working capital change over time. So cash flow identity, very, very important. Also known as CFFA, it's equal to OCF minus NCS minus CNWC. Also equal to CFTC plus CFTS, and there are how you calculate each of those three pieces. OCF I can get by going to the income statement, EBIT plus D minus D. And net capital spending is ending net fixed assets minus beginning net fixed assets, gross them up with depreciation. The other way to calculate NCS is ending gross fixed assets minus beginning gross fixed. For some reason, our author doesn't look too closely at gross fixed assets. If they would, we could just use ending gross minus beginning gross. It would be much simpler. And finally, change in net working capital, ending current assets minus current liabilities, minus quantity beginning current assets minus current liabilities. That concludes our session 2 on financial statements, taxes, and cash flow.